Thanks, sir. So thanks everyone for joining. We're just going to wait a minute just for other people to join the webinar. Okay, so now we'll get started. Just a quick introduction. My name is Tyler. I'm a consultant here at Sapling Financial Consultants. And today we're going to talk about the current economic climate in Canada and the US, followed by a discussion on activity-based costing models, or ABC models for short, and their utility in environments characterized by changing cost structures such as today. First, we're going to give a brief overview of the services we provide at Sapling. Then we'll proceed with a discussion on the current state of the US economy and Canadian economies, followed by an intro to ABC models, then discuss some case studies of ABC model projects that we've worked on at Sapling, and how managers can use these models that we've built to improve their decision-making in the face of rising costs, specifically tariffs. Then lastly, we'll open up the floor to any questions from the audience. So just a quick thing about Sapling. Sapling is a boutique consulting firm. We specialize in financial modeling, data analytics, and due diligence services for predominantly mid-market companies, PE firms, and search funds. And really the value that we provide is a high-quality service that addresses both the finance and modeling side, as well as the data analytics and IT side. So we have two teams that bridge this gap, enabling us to provide a full turnkey solution to problems faced by companies in terms of getting and working with data, followed by presenting it in a manner that's suitable for financial professionals to understand. So here's the major projects that we work on related to each vertical that was mentioned previously. Under the diligence, we specialize in quality of earnings, or QEVs, for M&A and new or follow-on investments. In financial analysis, we work on financial models, which span from regular three-statement models to LBOs, 13-week cash flow models, all the way to costing models for internal management. In data analytics, we build Power BI dashboards and help with automation of tasks related to working with data. And lastly, we also offer outsourced modeling and FP&A support for firms. In terms of our experience, some notable clients we've worked with include USP firms such as Audax and Trivest, sovereign wealth funds like the Abu Dhabi Investment Authority, and Canadian PE funds like Torquest and DW Healthcare Partners. We also have experience addressing across a wide variety of industries, ranging from consumer to food and beverage, all the way to industrials and healthcare. So with that, moving on to the economic outlook. But first, just a quick polling question. What's your current outlook on the Canadian and US economies? So that's interesting. It's kind of in line with what we'll see today in terms of the economic data we're seeing. It's a bit more positive in the US, but the results are negative in terms of Canada recently. So firstly, economic growth. On this slide, we presented quarterly real GDP growth in the US and Canada since 2021. Canada is the green line and US is the purple line in the chart on the right. As a reminder, GDP, or gross domestic product, is the most common measure for the size of an economy, measuring the total value of goods and services produced by that economy over time. And real GDP, again, is just adjusted for inflation. In terms of Q4, both the US and Canada experienced real GDP growth. In the US, GDP growth held steady at 2.3% annualized, matching forecasts but slowing down from around 3% in the prior 2 quarters. Consumer spending remained strong at around 4%. Well, there was a shift. Good spending revised lower to 6.1% from 6.6%, and services spending edged up to 3.3% from 3.1%. Investment trends were mixed. Non-residential investment declined further in the low single digits. However, residential investment was solid at around 5%. As well, government spending picked up 3%, led by federal outlays and state and local spending. And finally, net exports made a slight positive contribution, as exports declined less than expected, while imports fell sharply. Turning to Canada, Q4 GDP surprised the upside, rising to 2.6% year over year. Q3 growth was also revised higher to around 2.2%. Drivers of this was household spending, which rose 1.4%, the strongest growth since Q2 2022, with higher spending on new trucks, vans, and SUVs leading the rise. Residential construction also grew around 4%, the largest quarterly rise since Q1 2021, supported by strong resale activity and new construction. Investment in non-residential structures also impressed, up around 0.7%, and investment in machinery and equipment was up 4.2% due to spending on industrial machinery. Further, exports climbed 1.8%, which was driven by demand for precious metals, energy, and autos, while imports only increased 1.3%. In short, while U.S. growth has moderated, Canada's economy has shown surprising resilience in Q4, driven by strong consumer demand and investment, despite lagging the U.S. over the prior quarters. Moving on to inflation and central bank policy. On this slide, we presented for the U.S. and Canada the monthly CPI on the left and the policy rates on the right. Canada, again, is the green line and U.S. is the purple line. Just a refresher, CPI, or Consumer Price Index, shows the average price paid by consumers for goods and services, while policy rates represent the rates set by central banks on what banks can charge each other on reserve balances lent overnight. For the U.S. in Feb, the U.S. CPI rose 2.8%, down 3% in Jan. The biggest driver for this was shelter, accounting for around half of the increase. Food prices also played a role, which was driven by the food away from home. Grocery prices were flat. As well, energy prices, energy was mixed in terms of electricity and natural gas, pushing the index higher, offset by declines in gasoline prices and airline fares. Turning to Canada, Inflation came in at 2.6% year over year in Feb, up from 1.9% in January. The key driver for this was the end of the GST/HST holiday, putting upward pressure on prices. As well, shelter costs rose 4.2%, transportation was up 3%, and energy prices saw a notable jump, with gasoline prices up 5.1%. Moving on to central bank policy rates. In the US, the Federal Reserve has held its target Fed funds rate at 4.25 to 4.5% as of March 25, while the Fed cut rates by 50 basis points in September and 25 basis points in November and December. Progress on inflation has been slow. Looking ahead, the Fed is projecting 2 more cuts totaling 50 bips by the end of the year, but officials remain cautious given the inflationary backdrop. In contrast, the Bank of Canada has been more aggressive in cutting rates. As of now, the overnight rate stands at 2.75%, followed by a 25 basis point cut earlier in March. And since mid-2024, the BOC has implemented a series of rate reductions, including 3 basis point cuts last summer, followed by 2 basis point cuts in the fall. With ongoing uncertainty, however, from tariffs and inflationary pressures from loose monetary policy, the Bank of Canada is signaling a more cautious approach going forward. Moving on to labor market trends. On this slide, we have non-farm payrolls, which is essentially the number of paid workers in the economy, excluding farming and nonprofit industries on the left. And on the right, we have the unemployment rate, which is the number of people without a job that are seeking work as a percentage of the labor force. In the US, in March, the US economy added 228,000 non-farm payrolls, surpassing the forecast of 135K, and marking an improvement from Feb's 117,000 additional jobs. The healthcare sector was the leader for this growth. Further, the unemployment rate edged up to 4.2% from 4.1% in Feb. The labor force participation rate remained steady at 62.5%, and average hourly earnings increased 0.3% month over month and 4% year over year. In contrast, Canada's labor market experienced a decline, losing 33,000 jobs in March, the first decrease since Jan 2022. This decline was due to a loss of 62,000 full-time positions, offset by some gains in part-time employment. Unemployment rate stands at 6.7% in March, up from 6.6% in Feb. Labor force participation is around 65%, and average hourly earnings, however, have increased in Canada by 4%, aligned with the US. In summary, while the US labor market showed robust job growth in March, Canada's unemployment figures declined, highlighting a divergence in performance between the two countries. Moving on to industry and production. On this slide, we're looking at the Purchasing Managers Index, or PMI for short, for both the services and manufacturing sectors in the US and Canada. And just as a reminder, PMI readings above 50 signal economic expansion, while readings below 50 indicate contraction. Starting with the US services PMI, we saw a strong rebound to 54.3, driven by improved demand and better weather. Exports, however, fell for the third straight month, and hiring remains cautious. Notably, input costs surged to an 18th-month high, squeezing margins, while business confidence fell due to policy uncertainty. In contrast, Canada's services PMI dropped to 41.2, the fourth consecutive month of contraction. New business declined sharply, largely due to tariff uncertainty. Labor and supplier costs added to pressure, and overall confidence hit a 5-year low. Turning to US manufacturing, the PMI dipped to 50.2. Output slowed, new orders saw modest gains, and firms cut input purchases. Exports also remain weak, though there was some support from Canadian and EU demand. Rising costs pushed selling prices up, yet sentiment fell. And finally, Canada's manufacturing PMI dropped further to 46.3, weighed down by the tariffs from the US on goods and services. This is important given that 75% of Canada's exports go to the US, driving new orders down. So in summary, US services are showing strength, but manufacturing is under pressure, while Canada is facing a more broad-based contraction across both of these sectors. Moving on to financial markets, specifically equity markets. On this slide, we've presented the prices of the S&P 500 and the S&P TSX Composite. These are essentially a gauge on the level of consumer wealth, which through the wealth effect drives consumer confidence. As of today, the S&P has declined around 17%, reflecting investor concerns over recent tariff implementations and escalating trade tensions. The forward PE ratio stands at around 18 times, below the 5-year average of 20, and the 10-year average of around 18.3, indicating a more cautious earnings outlook amid market volatility. On the Canadian side, the S&P TSX Composite has declined approximately 10% year to date, suggesting that the Canadian equity market is also experiencing pressure amid global uncertainties. And as of today, the S&P TSX 60 trades at approximately 17 times earnings, which is higher than historical averages of around 15 times, indicating a potential overvaluation relative to history. Turning now to the topic that is catching all the headlines today, the current trade environment. So as of April 2025, global trade tensions have reached new heights, with the US and its major trading partners locked in a rapidly escalating tariff standoff. As a brief recap, the tariffs being implemented are part of the US's sweeping policy to restructure critical supply chains and also reduce its trade deficits, which have been negative since the late 70s and early 80s. In terms of recent developments following April 2nd, with a specific focus on the US and Canada, 10% tariffs have been implemented on potash and energy, and 25% tariffs on all other imports that are non-CUSMA or Canada-US-Mexico Trade Agreement compliant, meaning that CUSMA-compliant goods still do not face tariffs. Having said that, the US did sustain 25% tariffs on steel and aluminum, and 25% tariffs on all car and truck imports from Canada. In response, Canada has launched 2 phases of retaliatory tariffs. The first was a 25% tariff on 30 billion of US goods, and more recently, Prime Minister Mark Carney announced a 25% tariff on US vehicle imports that don't comply with CUSMA. In terms of the US tariffs on the rest of the world, a 10% flat tariff on all imports was effective April 5th. This was followed by steep country-specific tariffs, 34% on China, 20% on the EU, and 24% on Japan, all effective April 9th. In addition, a 25% tariff on foreign automobiles was implemented on April 3rd. China has responded in kind to these tariffs. On April 4th, it announced its own 34% tariff on all US imports, set to take effect April 10th, followed by another 50% tariff this morning, mirroring the US's action, which was a 50% tariff on Chinese goods, for a total tariff of around 104%, including the 20% tariff on Chinese goods in March. These back and forth measures are not just headlines. They're reshaping global supply chains, rattling markets, and fueling uncertainty across industries. So just to summarize, as of year-to-date 2025, the economic divergence between Canada and the US is becoming increasingly clear. While the US economy shows resilience, Canada is facing mounting challenges. In the US, we're seeing sustained real GDP growth, job creation, and low unemployment. Retail sales have also remained strong through Feb, and housing prices continue to rise. However, services PMI showed some improvement, and manufacturing, on the other hand, showed declines. But Canada is lagging behind. Real GDP growth and job growth are slower, while unemployment remains higher. Retail sales also fell in Feb, reflecting weaker consumer confidence and stagnant housing prices. On top of that, both the services and manufacturing PMIs have worsened through March. And with tariffs adding further uncertainty to the economic landscape, businesses are facing increasing challenges, making accurate costing and financial planning ever more important. So just another quick poll. What in your opinion is the greatest uncertainty facing the Canadian and US economies? Yep, so the result is trade policy, and that definitely aligns with current market sentiment. So moving on to intro to ABC models. But first, again, just another quick polling question, this time on the costing method that your organization primarily uses. So pretty mixed, that's interesting. Another polling question, just on your familiarity with activity-based costing. Yep, and that makes sense, aligned with what the previous poll was saying. So before we dive deeper into activity-based costing models, let's just quickly recap what cost accounting is and why it matters. So cost accounting is a system for tracking, analyzing, and managing costs within a business. It provides the foundation for financial decision-making, helping companies understand the cost of producing goods or services and improving profits. There's three key focus areas: cost control, which is identifying and reducing unnecessary expenses; cost allocation, which is assigning costs to specific products, services, or departments; and thirdly, decision making, which is providing insights for pricing, budgeting, and financial planning. When it comes to costing methods, there's two main ones: traditional costing, which allocates overhead based on broad measures like labor hours or machine hours, and activity-based costing, or ABC, which assigns costs based on actual resource consumption, providing a more accurate picture of the business. And lastly, why it matters is that cost accounting plays a crucial role in accurate pricing, cost reduction strategies, and overall financial health. So with this foundation in mind, let's explore the first methodology, being traditional costing, before moving to the focus of this webinar, activity-based costing. So to provide a quick overview of traditional costing is a method that assigns overhead based on a single cost driver, like machine hours or labor hours. And how it works is overhead costs are pooled together, and a predetermined overhead rate per cost driver unit is determined and allocated to the products or services of the company. Pros of this method are that it's simple and easy to implement, and it works well in environments with uniform production processes. Cons are that it can lead to inaccurate cost allocation, especially in companies with complex operations. To better explain traditional costing, we presented a hypothetical example of an auto parts manufacturer. This manufacturer produces two products, brake pads and engine mounts. The company has $100,000 of overhead costs that it needs to allocate between these two products. So to allocate between these two products, the company uses machine hours, a typical measurement used for traditional costing. An overhead rate per machine hour is then derived by dividing the total overhead costs by the total number of machine hours. In this case, that would be $100,000 divided by 10,000 machine hours to get $10 per machine hour. With this overhead rate per machine hour figure of $10, we can then multiply it by the total machine hours related to each product to get the total amount of overhead attributable to each product. So that would be $60,000 based on 6,000 machine hours for brake pads and $40,000 for engine mounts based on 4,000 machine hours. And lastly, this cost allocation is divided by the total amount of units produced for each product, which is 5,000 for brake pads and 2,500 for engine mounts, which the end result is a cost allocation of overhead of $12 per brake pad and $16 per engine mount. Moving on to activity-based costing, or ABC. This is a method that allocates overhead based on actual activities that drive costs rather than a single cost driver like machine hours from the prior standard costing example. The way it works is that activities which consume resources of an organization are identified. Cost pools related to an organization's resources are then allocated to these activities. And finally, these activities are allocated to the organization's products based on their usage of each activity. The pros of this method are that it can provide a more accurate cost allocation, especially for organizations with complex production and diverse products. And with this detail, it can identify inefficiencies. Cons of it, however, are that it's more complex and time-consuming to implement and requires detailed data tracking that organizations may not possess. So for example, clocking of hours per work performed by employees to understand the distribution of their labor hours on the tasks they perform may not be a standard process for companies. Therefore, determining the appropriate allocation of their time may rely on less concrete data sources like surveys. Before we dive deeper into an ABC example, though, we think it's important to just clarify how the methodology works. So ABC models, again, consist of 4 concepts. This is resources, which are the factors of production required to carry out activities, for example, labor or machinery. Next are resource drivers. These are resource measures that enable the allocation from the resource cost pool to a particular activity. So for example, if your resource is labor, then labor hours would be the resource driver to allocate costs in the form of payroll to particular activities. Thirdly, there's activities. These are the tasks performed by the organization to produce its products or services. If we're looking at a manufacturing company in food and beverage, for example, one of these activities would be packaging. Different products may have different packaging requirements in different batches, which could drive unique activity counts between products. Fourthly are cost drivers. These are the measures for the activities. And to carry on from the previous packaging example, for example, would be the number of packaging runs or batches, or weight or volume of goods packaged. This differs from a traditional costing model. For, again, traditional costing models are simply allocating these packaging costs into a single cost pool called overhead, and then allocating that with a single driver like machine hours. So with these resources, resource drivers, activities, and cost drivers, we have the framework for an ABC model. As shown in this graphic, it starts with resources. These are then identified and allocated using resource drivers to activities. And once these activities have been fully allocated, then using cost drivers, they're allocated to the products and services of the company. Moving on to an ABC example, we use the same auto parts manufacturer from our traditional costing example. For the ABC analysis, however, we first must identify the resources, resource drivers, activities, and cost drivers of the company. Resources and the resource drivers in this case include labor, driven by labor hours, equipment, driven by machine costs, facility costs, driven by square footage, and utilities costs, driven by electricity usage in kilowatt hours. We also show examples of what these resources would be. And for example, labor would include machine operators and supervisors on the factory floor. Then finally, the total overhead cost for each resource is shown, and adds up to the same amount of 100,000 from the prior example. Following this, activities and their cost drivers are identified, including molding, driven by machine hours, machining, driven by the number of setups, painting, driven by paint volumes, assembly, driven by labor hours, inspection, driven by the number of inspections, and packaging, driven by the number of units packaged. Once these concepts have been identified, the ABC model can then be built out. In this first step, we're allocating the cost pools by resource to their related activities. As you can see, labor costs are being allocated by the labor hours associated with each activity, equipment by machine costs, facility by square footage, and utilities costs by electricity demand for each activity. The percentages shown in the resource driver allocation percentage section are the end results of these allocations for labor hours, machine costs, square footage, and electricity usage. These total resource costs are multiplied by the resource driver allocation percentages to get the cost of each resource for each activity. These resource pool allocations each activity are then summed to derive a total activity cost estimate, as can be seen in the column on the right titled Total Activity Costs. which totals to the initial resource overhead cost allocation of 100,000. So to recap, just for an example, in the labor column, $40,000 is allocated across the activities like molding and machining. So 5% of 40,000 would go to molding, 5% to machining. And that same methodology applies to all the resources to then be summed up in the column to the right to get the activity costs. With the activity cost determined, we can then move on to the final step of the ABC method, which is to allocate these activities costs to the organization's revenues. Shown at the top of this chart are these activities costs from the prior slide and their cost drivers, being machine hours for molding, number of setups for machining, paint volumes for painting, labor hours for assembly, inspections for inspections, and number of units packaged for packaging. Going back to the prior example, again, this auto parts manufacturer has two products, being brake pads and engine mounts. In this case, each of these products has different amounts of cost drivers for each activity. So for example, under molding, you see 6,000 machine hours for brake pads and 4,000 for engine mounts. So using these activities per product, we can then allocate the activity cost. So using that example of the molding, 60% of the cost for molding would be allocated to brake pads and 40% to engine mounts. Similarly, 5 out of 15, or around 33% of machining costs be allocated to brake pads and around 66% to engine mounts. This same process is done for each activity and results in a total activity cost per product per year. But the main goal here is to get the unit activity costs. So we would need to take the total activity cost per product per year and divide that by the units produced to get the unit level costs for each product. By doing so, we can sum up each of these unit level activity costs and derive the total ABC estimate of cost for brake pads and engine mounts. And as you can see in the total cost column, at the bottom, the resulting allocation is $8 and $24 for engine mounts and brake pads. So with this example in mind, we wanted to show the unit costing results of this hypothetical case of the auto parts manufacturer producing two different auto parts that have different processes when employing traditional costing versus ABC method. While this example was using made-up figures, the point that we're trying to get across here is that the traditional costing approach doesn't properly allocate costs for companies with products or services with processes that materially differ from each other. So just to summarize, the decision between using traditional and ABC costing methods is not about which is better or worse. It's about identifying which methodology better allocates the organization's indirect costs to its products or services, factoring in data availability and quality, as well as company time and resources. For a simple organization with a uniform product mix, the traditional costing method works well and is especially favored due to its easier implementation and maintenance. However, for more complex organizations, the traditional costing method has its shortfalls that the ABC method addresses with greater accuracy. Organizations with diverse product lines with varying resource usages are such an example where traditional costing falls short, leading to suboptimal pricing and cost control decisions. The ABC method, on the other hand, provides a better estimate of the proper cost allocations for these types of enterprises, enabling stronger decision-making for pricing, process improvements, and cost reduction based on analysis that's grounded in sound data and allocation drivers that are aligned with the processes of the organization. So with this understanding of the ABC method, we think it helps to provide some real-world examples of the ABC models and costing models that we've worked on at Sapling. We're first going to discuss a costing model built for a services firm, specifically in the construction industry, followed by a costing model built for a goods-producing firm, specifically a contract brewer. Then we're going to provide some managerial decisions that can be made using the costing models, created with a specific focus on how they can be used within the lens of tariffs and their direct effects on company costs. So the first case is a costing tool for a services sector business, specifically a mid-sized construction firm specializing in major infrastructure projects here in Canada. The client was having difficulty in managing budgeting for its construction and finance teams at a project level back in 2021, a period characterized by significant price increases in key materials and inputs, as well as a shortage of skilled personnel. For construction companies working on infrastructure, revenues are often fixed based on their RFP proposal, so controlling costs and having enough cost visibility and granularity as the project progresses is vital. The objective of the tool Sapling built was to enable the construction and finance teams to update project costs, including labor, materials, and overhead allocations on a monthly basis. Key considerations for this related to the labor-intensive operations of construction, subcontractor costs, equipment depreciation, and material cost variability due to price changes during COVID. So let's just walk through the implementation journey of this first case study, which followed a 4-phase approach. Phase 1 was the model plan. We began by designing a tailored model structure, incorporating contractual costs, change orders, and indirect costs, laying the foundation for an accurate and practical tool. Phase 2 was model construction. Once management approved the model plan, we moved forward with the build, constructing the model in line with the structure we pitched. Phase 3 focused on validation and refinement. Here we calibrated and quality checked the model, making adjustments as needed, and validated the final product with leadership. And finally, phase 4 was adoption. This is where the model's insights were successfully integrated into real business processes, specifically bidding, budgeting, and cost control, driving smarter decisions across the board. And this structure ensured that we delivered both value and usability in a model built for real-world application. Following implementation, this project delivered 3 key outcomes. Number 1 was reporting consistency. The standardized project costing model created a scalable framework that could be applied across all projects that the company engaged in. This ensured profitability reporting was consistent, accurate, and comparable on a firm-wide basis. Secondly was streamlined analytics. By using a uniform model structure, the team was able to speed up financial analysis and enable cross-project comparisons. This made it easier to identify trends in efficiency and profitability across different jobs. And thirdly was operational efficiency. The automated, consistent model structure significantly improved monthly update process for project costing. What used to be a manual, time-intensive task became a streamlined and repeatable workflow. Together, these outcomes show how a well-designed model can drive better reporting, smarter analytics, and operational gains at scale. So now let's look at how this construction firm could respond to rising costs from tariffs. On the left here, we outlined 4 key strategies. Number 1 is cost pass-through. This would involve raising prices to offset higher input costs from tariff rates. Number 2 would be supplier negotiation, which would be identifying materials with the highest cost exposure and exploring pricing alternatives with those suppliers. Number 3 is project selection and pricing, which is focusing on higher margin and negotiating cost-plus contracts where possible, just to reduce risk of cost overruns. And number 4 is operational adjustments, such as purchasing materials ahead of tariff implementations. On the right here, we show a bridge maintenance project taken on by this firm that relied heavily on steel. Around 25% of material and supplies and 50% of subcontractor costs were tied to U.S. imported steel. With a 25% tariff applied, these input costs spike, increasing project costs and the total cost line from 98 to 98.6 million from 93.4 million, and cutting the firm's gross margin from around 9.6 million to 4.4 million. And also the gross margin percentage declining from 9.3% to around 4.3%. However, with a cost pass-through strategy, the firm would increase pricing to offset this cost impact. The dollar gross margin in this case, in the third column, would increase back to 9.6 million, but the margin percentage declines slightly to 8.9% as profits are held steady over a higher revenue base. This just highlights the importance of using detailed costing models to make proactive pricing and sourcing decisions in response to external cost pressures like tariffs. The next case study focuses on a contract brewer producing for multiple brands, each with its own cost profile and margin expectations. The main challenge was the complexity of allocating overhead accurately in this case. With fluctuating input costs and varied production runs, the client faced ongoing margin uncertainty and limited visibility into what was truly driving profitability. Sapling was engaged here to implement an activity-based costing model to improve cost visibility and support more informed pricing decisions. In doing so, we had to account for several key considerations, such as product complexity, variable batch sizes, labor and utility inputs, and plant and equipment, all of which could skew true cost and margin calculations. By addressing these factors, however, with a structured ABC approach, the brewery could finally see what each product truly costs to make, setting the stage for better decisions and stronger margins. So again, let's walk through the 5-phase implementation journey in this case for this project. So the first phase began with data collection, identifying key company resources like labor, equipment, and building costs, as well as operational activities like milling, brewing, and fermentation. Next, in phase 2, involves cost driver analysis, where we matched resources to activities using resource drivers. For example, labor hours for labor costs and square footage for building expenses. We then assigned cost drivers like malt volumes and tank hours to allocate activity costs to products. With the groundwork in place, we then moved to phase 3, which was model construction, building out the ABC model based on the structure that we confirmed with the management team. Next, in phase 4, involved validation and refinements, where we fine-tuned the model in response to leadership feedback, ensuring it reflected operational realities and management priorities. Finally, in phase 5, adoption, the insights were fully integrated into real-world decisions, supporting improved product pricing, refined production mix, and margin control. This structured rollout ensured both accuracy and organizational buy-in. In terms of outcomes and lessons learned, through the implementation of the ABC model, the client gained much greater cost transparency, allowing for more accurate cost allocation across brands and product lines. And this clarity really helped the client adjust pricing strategies, identifying unprofitable SKUs and making informed decisions that improved margins. Operationally, the model revealed inefficiencies in specific production runs, creating clear opportunities to streamline and cut waste. And from the client's perspective, there were several key lessons learned. First was selecting the right cost drivers was essential to generating actionable insights. Second, they experienced resistance to change, especially within operations, highlighting the need for strong change management. And finally, they realized that the model isn't a set and forget tool. It requires periodic recalibration to stay aligned with the business's updated costs. Overall, the ABC model didn't just provide insights, it empowered the client to make smarter decisions and built a foundation for ongoing cost improvement and profitability improvement. So now again, let's walk through a managerial decision-making case in terms of the options for this contract brewer, specifically how rising tariffs would impact production of ale at their plant and what can be done about it. As with the first case, we've laid out the decision options on the left, and on the right, you'll see the costing model outputs comparing the scenario with no managerial response to one where a decision, in this case, supplier negotiation, is implemented. In this context, supplier negotiation means using insights from the costing model to renegotiate terms with vendors based on where tariffs are hitting hardest. So due to a 25% tariff on aluminum and steel, equipment and packaging costs for ale production rise by about $2 per hectoliter, pushing unit costs from around $50 per hectoliter to $52. At the top there, if the selling price stays flat at $60, contribution margin drops $10 per hectoliter to $8, and margin percentage falls from 16.7% to 13.2%. However, if the company successfully negotiates with its aluminum and equipment suppliers, in this case, for example, to each share 50% of the tariff burden, cost increases are halved. That brings total unit costs to $51 per hectoliter, raising contribution margin to $9 and margin percentage to 14.9%. This example just underscores the value of activity-based costing. When companies understand their cost drivers at a granular level, they can take proactive steps like supplier negotiations to preserve margins and profitability under pressure. So just a quick polling question. Would you consider expanding your use of ABC in response to changing cost pressures? Yeah, so really high result there. Definitely highlights the uncertainty that businesses are facing in terms of tariffs. So as we wrap up, it's important to recognize that the economic performance of Canada and the US has been diverging, creating unique pressures, especially for Canadian companies. Tariffs are one such added headwind, further intensifying the need for clear visibility into costs. In this environment, understanding your organization's cost drivers isn't just helpful, it's critical. That's where activity-based costing comes in. It's a highly effective tool for companies with complex and varied operations, whether in manufacturing or services. At Sapling, we've implemented ABC models across a wide range of industries, and every time the result has been the same: actionable insights that empower management teams to make proactive, data-driven decisions that boost profitability, even in the face of rising input costs. With that, I'll pause here. Thank you for your time, and I'm happy to open the floor for any questions. So the first question, what are common signs that a business may benefit from switching to an activity-based costing model? Key signs could include unexplained margin compression, especially in high volume or customized products, or pricing decisions that appear disconnected from actual cost structure, as well in overhead allocation methods based purely on headcount or direct labor, which can often oversimplify the distribution of costs. ABC is particularly when products, customers, or service lines consume shared resources differently. It helps unpack overhead and distributes it based on real drivers. Again, be it machine time, setups, whatever is the activity driving the organization's business. The next question is, how does ABC improve decision-making compared to traditional costing methods in both service and manufacturing settings? So traditional costing allocates indirect costs uniformly, often based on a single measure like labor hours, which distorts true unit economics. ABC breaks costs down by activity, linking them to resource consumption. In services, it allows firms to understand which clients or service lines demand more time or support. In manufacturing, it reveals how complexity, not volume, drives costs, like the difference in overhead between producing 1,000 units in a single batch versus 10 batches of 100 units. That just leads to better customer segmentation, product line decisions, and strategic cost reductions. Third question is, what are the biggest challenges companies face when identifying accurate cost drivers, and how can they overcome them? Challenges include lack of visibility into processes, inconsistent data, and organizational silos. Sometimes the cost driver isn't obvious or isn't tracked, like the number of design changes, instead of just taking, for example, engineering labor hours. Overcoming this requires engaging the teams, investing in better operational data systems, and piloting the model in a contained business unit before scaling it. It's also important to strike a balance. Too many drivers can create noise, diminishing the model's usability. The next question is, how long does an ABC analysis engagement with Sapling typically take in a manufacturing environment, say for a business with around 50 to 100 million in revenue? So it depends on really the availability of data. If it's readily tracked and recorded, and it's well understood what the organization's activities are, and that can be explained in a very methodical and quick manner, the engagement could be quicker. But in terms of the cases we've worked on, they've lasted a few months just due to the difficulty in obtaining the right data and kind of going back and forth between the company and really identifying that unit level information that we need to properly allocate the company's costs. So it seems like there's no other questions in the chat. With that, I'll just give it another minute, and that will then conclude the webinar. Yep, and one person requested a copy of the slides and a link to the webinar for sure. We'll definitely send that your way. So that kind of concludes the presentation. Thanks again, everyone, for attending. Be sure to reach out to Sapling Financial Consultants if you ever need an activity-based costing model built. Thanks.